Let's jump right into this explainer and put Nordic American tankers through what I like to call a grueling valuation stress test. We're stepping into the shoes of expert investment analysts today. We've got a mountain of raw data in front of us: financial reports, geopolitical shipping updates, insider trading logs, you name it. And we are going to run all of it through the legendary valuation frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, before we strip away all that philosophy and run some pure, cold hard, discounted cash flow models. Let's get to work.
Here is our roadmap for today's crucible. First, a quick company snapshot. Second, we look through the Buffett lens. Third, the Lynch lens. Fourth, the Graham lens. Fifth, DCF and alternate models. And finally, number 6, we synthesize it all for our final verdict.
All right, Section 1, Company Snapshot. Let's establish a baseline understanding of what Nordic American Tankers, often just called NAT, actually does. NAT operates in a highly commoditized shipping business, and right now that business is directly tethered to macro geopolitics. Think about things like the recent closure of the Strait of Hormuz or the US-Iran Memorandum of Understanding. Because global tanker supply is completely inelastic in the short term, any disruption, like say the 15 million barrels a day impacted by the Hormuz closure, literally sends spot rates soaring. So you have to remember, the company doesn't really control the price of its service. The global political landscape does. It's wild. Operating a fleet of 18 versatile Suezmax tankers, NAT boasts a staggering 115-quarter dividend streak. Plus, their balance sheet is really improving, which makes it a super intriguing play at its current price of around $5.26. I mean, their first quarter was phenomenal, netting $46.3 million, which actually beat their entire full-year net result projected for 2025. With their net debt to free cash flow ratio plummeting over 55% year over year down to a very healthy 1.84, they are absolutely flush with cash right now. Moving on to Section 2, the Buffett lens. Now, what's really interesting here is seeing how NAT actually holds up to the famously strict criteria of the Oracle of Omaha. As we know, Warren Buffett looks for economic moats, consistent earnings, high returns on equity, manageable debt, and honest management. So how does NAT grade out? Well, management is definitely honest, and that debt is highly manageable. But NAT totally fails Buffett's moat and earnings consistency tests. Why? Because shipping rates fluctuate wildly based on unpredictable global events. Sure, management is aligned with shareholders. They're actually the largest private shareholder group. But Buffett demands a true economic moat, real pricing power, and predictable earnings. NAT is just a pure price taker in a highly cyclical commodity-style business. And then there's this number. Even with a really solid $60 to $64 million in estimated annualized owner earnings, which is the true free cash flow available to owners, the sheer capital intensity of this business remains a massive hurdle. Buffett loves businesses that require very little capital to grow. But NAT, they operate massive steel ships in saltwater. They require heavy, constant maintenance, and NAT just had to commit to massive capital expenditures for 2 new builds due in 2028. So, the crucial takeaway here, Buffett would avoid this completely. He actively eschews cyclical businesses with unpredictable cash flows because, for him, that means there's zero reliable margin of safety. He simply wouldn't be able to confidently project their cash flows 10 years out, making it impossible to calculate a true intrinsic value he'd actually trust. Let's pivot to Section 3, the Lynch lens. Peter Lynch famously categorized companies to determine exactly how to play them, whether they're slow growers, stalwarts, fast growers, or cyclicals. Before we apply Lynch's metrics, we have to talk about the PEG ratio. Remember, this helps us weigh a stock's trailing PE against its projected growth. Lynch absolutely loved a P ratio below 1.0. For NAT, the trailing PE is sitting around 6.0 based on annualized recent earnings. But because long-term structural growth is basically negligible in the shipping industry, the PEG ratio is kind of an artificial metric here. Lynch would correctly categorize NAT right off the bat as a cyclical play. And you know what? He'd be absolutely thrilled by their pristine balance sheet and the recent massive 400,000 share purchase by the Hansen family. The CEO and vice chairman recently bought huge chunks of shares at $5.26 and $5.16. Lynch always said, insiders might sell for a million different reasons, but they only buy for one. They think the price is going up. On top of that, low institutional ownership is a classic Lynch buy signal. So Lynch's verdict? It'd be a buy or hold right now. He'd favor that strong insider activity. But he would strongly warn you to sell before the looming global tanker order book completely crushes rates in 2028. The rule is you buy cyclicals when the PE is low and fundamentals are strengthening, but you absolutely have to know when to jump ship. All right, Section 4, the Graham lens. Moving to the father of value investing himself, let's see how Benjamin Graham's defensive metrics judge Nat. Graham wanted mathematical certainty. He wanted hard asset protection to ensure a true margin of safety against downside risk.
Graham's strict intrinsic value formula combines earnings per share and book value to find a mathematically safe entry point for a defensive investor. This formula basically caps the acceptable PE ratio at 15 and the price-to-book ratio at 1.5, which is exactly where that 22.5 multiplier comes from.
Now this is wild. Amazingly, despite totally failing the earnings stability check, Nat passes 4 out of 5 of Graham's defensive investor checks. It's all thanks to their intense asset coverage and that flawless dividend record. I mean, the company has over $900 million in total assets and a highly secure current ratio of roughly 3.0. They're holding nearly $195 million in current assets against just $65 million in current liabilities, all while maintaining a really moderate PE. When we plug in an annualized EPS of $88 and a book value of $2.15, Graham's formula reveals a surprisingly high intrinsic value of $6.52. That actually offers a 19% margin of safety. If we take Q1's 22 cents as a run rate for EPS and divide the $455.9 million in shareholders' equity by the outstanding shares to get the book value, Graham's pure math says the stock is fundamentally undervalued at its current 5.26 price tag.
Okay, Section 5, DCF and alternate models. Now we're going to strip away the guru philosophies completely and look at the cold, hard math. We'll use a discounted cash flow and a few other quantitative models where we project future cash flows and discount them right back to today's value. If we run a base case DCF that models declining cash flows as that huge new ship order book delivers, it results in a pretty sobering fair value of just $2.65 per share. Here's our assumption breakdown. We assume a strong free cash flow of $120 million for the next 3 years due to the current geopolitical crunch, but in years 4 and 5, as that massive 25% global order book finally delivers and the market normalizes, we drop that to $80 million. With a 0% terminal growth rate and a 10% discount rate, the intrinsic value just craters.
And honestly, even if we put on rose-colored glasses, adjust our discount rate down to 8%, and bump terminal growth slightly, the DCF model still really struggles to justify the current market price. Looking at our most optimistic scenario here, an 8% weighted average cost of capital and a 1% terminal growth rate, the fair value only reaches $3.30. The DCF model just ruthlessly punishes any business that lacks long-term perpetual growth.
But on the flip side, a dividend discount model heavily rewards Nat's peak cycle yield, spitting out a $7.33 valuation. Meanwhile, comparable EV/EBITDA multiple suggests the stock is fairly valued exactly where it is today, right at $5.26. If you project out the current annualized 88-cent dividend and apply a 12% discount rate assuming zero growth, income investors see massive value. Applying an industry-standard 5x multiple to their annualized EBITDA lends us perfectly on today's market price.
Finally, Section 6, Synthesis and Final Verdict. As you've seen, we have wildly different valuations depending on which lens we look through. But honestly, that's completely standard for a highly cyclical asset like this. Let's pull it all together.
We're fundamentally comparing massive near-term tailwinds like high insider conviction and super tight supply against the devastating long-term risk of a massive global order book that could crush shipping rates by 2028. A U.S.-Iran Memorandum of Understanding could reopen the Strait of Hormuz, quickly easing the immediate supply crunch. Plus, the impending delivery of all those new ships means today's sky-high spot rates are almost certainly temporary.
Just look at the immense spread on this table. The gap between our harsh DCF reality at $2.65 and the generous dividend calculation at $7.33 perfectly captures the peak cycle nature of this stock. A DCF looks at the long-term structural cash flows and sees a shrinking pie. The dividend discount model looks at the massive cash distributions happening right now and sees a gold mine. The market, using EV/EBITDA, is splitting the difference and pricing it right down the middle. So, our final verdict based on all the data, we rate Nat a hold at $5.26. But the ultimate question is, at what price would the gurus pull the trigger? Buffett? He'd never touch it. Lynch might buy below $4.00 to trade the cycle. And Graham would demand a strict 33% discount to his intrinsic value, putting his buy target at $4.34. So I'll leave you with this. Are you jumping in to chase that massive peak dividend yield today? Or are you waiting patiently on the sidelines for Graham's bulletproof margin of safety?